Well, hello and welcome everyone to a very timely session on the current investment volatility we've seen over the past year. As we look back, there's clearly been some big distractions, including runaway inflation, the Fed's interest rate hikes, the war in Ukraine, and of course, the lingering impact from the pandemic, which seems like it must have been a long time ago. And that's why this may be such an ideal time to again provide some unique perspective to help everyone further understand how the current economic and financial conditions around us can potentially impact everyone going forward. With that said, I just want to give a special appreciation again to many of the contributors that have provided some extensive analytical research, which I basically help interpret in layman's terms. And that includes American Funds, JP Morgan, Franklin Templeton, to name a few. We're very grateful for their input, and especially just grateful to reach out to each of you. What we also want to do is share what the three key themes are on the minds of investors today, given the fact that 2022 happened to be the worst year for equities since the financial crisis of 2008 and 2009, which represents some really bad memories for a lot of people, even though it's also some good memories for some people who were probably allocated according to their goals, had a time horizon, may have dollar cost averaged along the way. We'll touch on some of that later, but it's still very memorable, and it does affect a lot of people. So what are the questions that people are asking today? Number one, what will fall in inflation mean for federal policy and interest rates? Okay, if they are successful, I know they're trying to get it down to 3% or possibly 2%. I doubt that. I personally think that a lot of what caused this inflation could have been prevented, and I think it'll take more to clean up, but let's get their input. Number two, will the US economy fall into a recession? I've often asked recently whether we were already in one based on what the definition has historically been, but that definition seems to change along the way. Third, could a federal pause bring relief for stocks? There is some history there, and it's somewhat even revealing, and we'll share some of that as well. So with no further ado, let's jump on inflation. As you remember, last summer, it went up to as much as 9%, the official target, and it hit approximately 6.5% by the end of 2022. Of course, we also want to be mindful that what we're paying for, each of us, depends on what we're buying. For a lot of people that are buying a lot of gas, energy, or spending on food, they were probably in the double digits. But the big question also may be for a lot of us, where do we currently stand with federal interest rate increases, which are also, as you know, needed often to combat inflation. And I want to add something there. Inflation tends to be like the cancer. It harms everyone, and it can be significant if it happens for a long time. All right. However, some of the interest rate hikes are almost like one of the forms of treatment. And if it causes a recession because of other certain restrictions, then I would call that I would make it equivocated to the chemotherapy. All right, which the short-term pain of those two things I think are a lot less than the long-term pain of inflation, which once again can hurt everyone significantly. There's no fun in that at all. So let us jump here and share exactly what some of those hikes were. We look here, we see that so many of the aggressive rate increases we saw last year, especially from June on, where we had 475 basis point increases at one point. Going into this year, we had just a 25 basis point increase in early January, expected maybe another 25 basis point increase later in the first quarter. So keep in mind though, higher rates can still be good for savers who would also like to continually save more, earn more yield, and spend less. So that can be a good thing. It's also an ideal time to remind everyone that yes, if any of us have too much money, excess money sitting in basic savings, checking accounts, or earning hardly anything, it would probably be a good time to consider maybe a short-term US Treasury portfolio, which we've actually done for some people just because the yields are so much higher. So now let's take a moment to move on to where we stand with the possibility of a recession this year. All right, there's some things to look at there. This chart, which I really like, is provided by the Federal Reserve Bank of Philadelphia. It clearly shows that the portion of professional forecasters who expect a recession is much bigger today than it's been in a long time. And as I said earlier, I was always questioning, whether we already were in one a lot sooner. In the last 200 years, there appears to be different definitions, but I think the fundamentals should still be the same. So the silver lining here obviously might be that it appears to be the most anticipated recession on record. I never heard so much information that really supported it in terms of preparing for one. And that means more investors and businesses are likely to be much better prepared. So with that said, let's also quickly address some of the current economic realities that could support for or maybe against a recession. All right, we can't always predict these things, but then again, do we have to? If you look here, you'll see that the reality is very mixed. On the cautionary side, we have an inverted yield curve, which really simply means that in today's terms, we have higher short-term one-year rates paying than we do 10, 20, or even 30-year rates. That's very odd, but it also creates a little caution, especially in the long-term fixed income market. We have decline in personal savings at a much lower level. We have a slowdown in manufacturing. So that always has some sort of a domino effect as well. On the constructive side, you've had a stronger labor market, at least on paper. I don't want to get too analytical, but when people leave the workforce, sometimes that makes that number look artificially lower. We also have, retail spending higher than usual, which if there is a recession, at least on record, that could change dramatically. And business resilience has been pretty strong, especially balance sheets. And a lot of those balance sheets have cash. Cash can obviously take advantage of opportunities that are created in a recession. So again, real good reason to say there's mixed messages, but another factor again would be the status of a likely pause in interest rate hikes, what that could mean over the next year. So one way to do that is to look at what's happened in similar situations in prior years. And if we go back to 1980, I like this as well. You'll see that even though the tech bubble of 2000 still moved into negative territory, everything was crazy back then for anyone that remembers that. It was a very disconnected time. Still, the average subsequent one-year return for all other cases where we had interest rate pauses was 15.7%, as you can see in the bottom in red. So the Fed pause could then be good news for most equities, apparently. So with that said, we may want to take a look at some key economic indicators, all right? Knowing that I want to also be mindful and share with everyone that the equities market and the economy are not the same thing. And I'm not even implying that. I just want to be clear because sometimes they move in opposite directions. It's sometimes unpredictable. But do we have to predict it? Not necessarily, but it is good to understand some of those indicators to at least be ahead of the game. And among those, as you can see here, starting to the left, you'll see consumer sentiment is below the historical range, which is usually in red here, and can expect it to go lower. We'll also see economic growth is right at the average range, expected to be a little higher. Inflation is at the higher end of the historical range, expected to go lower, at least in the short term, but I wouldn't rule that out. I think inflation will likely still be an issue for a while. And the same with volatility. It's projected, at least in the short term, to go lower, especially when you compare it to last year. But I think volatility will probably see that rear its head more so in the future, and maybe we'll touch on that later. Unemployment, that seems reasonable. Yes, on the lower end of the historical range, expected to go higher. And the U.S. Treasury rate, which we have covered, should go a little higher. One more variable I think that I like to mention, because I'm always mindful of David Walker, the former controller of the U.S. government, who often reminded us, without going into too much detail here, that if government doesn't get its spending in control and start, letting things get out of hand, which they have since then, because he told us this like 20 some years ago, then we're going to have a tsunami that people can't believe. And currently we have coming up to a $31 trillion debt, and that's on a cash basis. So for all you accountants and CPAs out there, you know what that means. An accrual basis is where we also declare the future liabilities, which would really look alarming. And I always think of the government financials as like an insurance company on a cash basis. And that's always dangerous. Not to panic anyone there, but I just want to be mindful that if you look at the last pandemic at a time where we probably needed more government spending, less than any other time, we had much more. And the margin between the spending and the tax revenues was the widest in over 60 years. So that's another obvious reminder for everyone. And I know I talk about this a lot, not to get off track, but we have to also prepare and be mindful of rising taxes and how we can create more tax efficiency going forward, because a lot of people, especially those who can afford it, are going to be expected to pay. And some of you out there are going to be expected to pay for those that can't afford it. Again, that's another subject for another time, but it all kind of relates as far as how we manage wealth and how we handle many of our longer and shorter term investments. So with that said, let's briefly address the most pivotal asset class that we're really here to talk about. Most importantly, that's equities. Of course, as an indicator, we use the S&P 500. Why? Because it owns so many of the greatest companies in the world that provides what we need and use every day. All right. When we look at a chart going back even to 1996, we can clearly see that, we've had a contraction of 20% last year. In the first 3 quarters, it was 25%. But it's also important to note, even looking at this chart, the magnitude of the expansions, which are typically much longer, much higher, as opposed to contractions, which are shorter and much lower. And if you go back even to 1929, which I think I highlighted before, the average contraction in equities downward was about a little over 35%, while the average expansion was above 115%. So there's a lot of continued history, even though we could go back to the year 1802, the Thomas Jefferson administration, to acknowledge that markets have always done 3 things. They've declined, recovered, and they set another record. Do we have to know exactly when that happens? No, fortunately, because it's almost impossible to actually nail down when it does those things. For a longer term investor, that's not going to matter as much. So with that said, let's take a quick look and see if there's any relationship between consumer confidence versus how the markets react, because it is a lot psychological. I think people are more volatile than actually companies. We can look right here. It's rather startling here. You don't have to get too caught up in this. Just look to the upper left-hand corner and I'll just explain it. When you notice, we hit consumer confidence peaks over the last 50 years when we have, if you look at the dots at the top of each interval, we noticed the next year only produced an average return of 4.1%. All right, that would be strange. You would think things would really keep going up when people are very confident, or that's how things are gauged. And when you look at the lowest troughs during that time, the following year actually averaged an amazing 24.9% return. Now, does that mean there's even more opportunities that are likely available during difficult times? There are a segment of investors that really understand that, but I'll let you answer that. I'll even just take it a step further and say, well, let's just wonder for a second how equities have historically responded, let's say after the past 10 or more recessions. All right, I like to dig deeper anyway, and history can really tell us a lot of things. So if you don't mind, we'll take a look at that. You don't have to analyze the chart. You're free to look at it, but it tells us, first of all, that drawdowns going into recessions have really been temporary, if you really want to look a little bit to the left. And the 1, 3, 5 year returns after recessions have been quite positive. So another big question then, just to go further, is how soon do equity markets usually peak just before a recession? Okay, and how soon do they then recover before the recession ends? Now, you might think, any normal person at least would think, okay, if there's a recession today or tomorrow, then we're likely, let's say, getting some of our equities out there safely on the sidelines. Who wouldn't feel that way? And if we're in a recession that hasn't ended yet, then we might think, well, hey, tell me when it's over and then I can go back and invest the way I should be. Well, that would be a normal instinct, I would think. But let's just then see then why there have been so many mistakes in this area in terms of market timing or just under or overreacting. Well, we can see right here in this chart, if you look to the top part in the middle, Compliments of America Funds provides that markets typically peak 7 months, as you can see, before the recession begins, and start to recover approximately 6 months before the recession ends. That's kind of interesting. It reminds me of something that Nick Murray, one of my favorite mentors, has often said, he's an author of the book, Simple Wealth, Inevitable Wealth, which is one of his many fabulous books. He has said before that if you sit around just waiting for springtime arrive, the robins would have already flown away at that point. And that's what that reminded me of right there. So all in all, clearly for anyone looking to embrace the opportunity for the next bull market, not that we ever want to insinuate any market timing, that can be ridiculous. All right, we must notice that many of those opportunities may be even more likely to occur in periods of downturns. So let's just check that out further. If we go back to 1946, where we've had downturns of 20% or more, okay, we can look here that we've seen that the negative average going to the bottom left was 32%. And the 1, 3, 5-year returns were 17.5%, 36%, and 61%. That's very telling. So I think that says a good story for equities, but let me be clear, for people who have a time horizon that I consider in their later bucket, if you ever heard me talk about the bucket planning process in terms of creating optimization to align assets according to risk levels, then I think we can use equities quite effectively because of what they do, especially if you're possibly systematically investing or dollar cost averaging into some of these uncertain cycles. With that said, let's go to their neighbor, fixed income. We usually need that to have an asset allocation, right? And the most popular would be bonds, of course. So we had to pay attention to the fact that bonds, speaking of which, had their worst year in the history of the markets last year. Well, I've been talking the past few years about having possibly shorter term bond durations and also a fixed income alternative. We should also take a look at the change in yields that we've seen in the yield curve and give us a little perspective there. All right. Again, I know I'm moving fast, but if you look to the left here at the 1-year rates, they've jumped from 0.38 at the beginning of 2022 to 4.73% at the end of the year. That's quite a jump. That's why we also have an inverted yield curve, as you can see, where the 1-year yield is higher than the 10, 20, or 30-year yield. That's kind of strange in a sense. So anyone out there, as I mentioned before, with a significant portion of just savings and sitting in the bank earning very little, should probably make sure to remind me about maybe setting up a short-term U.S. Treasury portfolio just for that segment. It's designed to be safe and maybe get a higher safe yield. We can also take a quick look at the aggregate bond index, which then can note the yields and durations going back over the last few decades. I think it's a telling story in a sense to give people perspective maybe as to why some of those aggregate bonds were a little disappointing. If you see in this chart, you'll notice that even during the pandemic, it was a dangerous time, 2020. Why? Because we had the lowest yields, 1.1%, as I recall, and the highest duration, 6.2%. That's not a good trade-off. And we can see now that we've had interest rate increases, bond yields at their highest since 2007. But the silver lining here, I want to be very clear and say this part a little slower, all right, is that the income is finally being brought back into fixed income. So that's not such a bad thing. Yields have clearly risen in each of the following asset classes under that aggregate index. You can see at the bottom, munis up 2.69 over 1 year. Aggregate bonds towards the top here up 3.54. High yields, just another example, up 5.1%. So with that said, there's been some little recovery, and rightfully so. This income being brought back into fixed income is at least helpful for some portion that we still keep fixed income assets using bonds. So next, let's just compare, since asset allocation is important, with a 60-40 portfolio. When we put the two together for some of those historical investors that I wouldn't necessarily rely on the 60-40, but let's just look at it now versus projections in the past versus the future. Okay, we can see here asset allocation is one of the most important variables in how we actually allocate retirement funds to manage risk levels and so forth. And again, there's more asset classes within fixed income, of course, than just bonds. But just for argument's sake, if we go back to 1976, weathering through some real tumultuous times, and especially equities and bonds, if you weathered through and were able to hold through, you averaged 10.9%, which is unusually high. even though there were periods of high inflation back in the 80s. If you look at the projections over the next 10 years from the perspective of JP Morgan, Goldman Sachs, BlackRock, and State Street, they say a projection would be probably 6.6 is somewhat of a more moderate figure or estimation. I don't call it necessarily a prediction or anything like that, but it probably appears a bit realistic given higher interest rates that we're in today, inflation that will probably linger, and future rise in taxes, just to name a few, that could maybe suppress things even a little bit further. So, but however, with that said, and I wanted to get this done in a timely fashion. I want to cover probably the most important area, which has a lot to do with behavior, and that's having a good foundation. It includes being in a position to always respond positively to any event, because we learn in life, no matter what endeavor, it's not just finance, it's in any profession, that how we respond to events determines really what it means to us, not just what happens. I know that sounds like positive talk. Well, probably because it is, right? But a great example can be shown in the story of 4 different types of investors. And we all have to remind ourselves, which one are we, or which one do you want to be? All right. And it's a real solid example where we take 4 people invested $10,000 each in the beginning of 2008. You know, they just got in before a big recession hit, of course. And you'll see here that the first one, the apprehensive investor, at the end of 2008 said, darn, I only got a little over $6,000. I got to stop the bleeding here, man. I feel like I'm going down a cliff here. So he put the money under the mattress, said, hey, I feel like I saved $6,100 because I was going to lose it all. Now, the uncertain investors reacted the same way at first. It was a little emotional, and then kind of got some logic or common sense back and said, you know what, that's not what I intended to do. These things recover. There is some good history here. I just missed 53% of the recovery, as you can see a little bit to the left here, right? So they got back in, and by the end of 2022 in the S&P, that person had a little over 21,000. So they feel better, especially standing next to the apprehensive person. The next one was a steady investor. The steady investor said, hey, my goals and objectives haven't changed. Why should my allocation change? I committed that $10,000 to my later bucket for longer term. It had a time horizon. I realized that the client recovered and set another record, and I can't necessarily time it. So I'm just going to just ride it out. And that person then was worth $26,000 with that account. So they did better than the uncertain investor, which means the uncertain investor may have lost $5,000 by just reacting at the end of the first year. Now, the opportunistic investor, on the other hand, which I relate to, looked at this and said, well, wait a minute, looked at his apprehensive friend and said, you know, there's a sale close to 40%. I can even buy up, nothing personal, but I can buy up a lot of the portion of his shares or his or hers that sold those, and I'll get a discount. So that worked out really well, because his balance at the end of 2022 is over 68,600, right? And out of that, just for the math, that extra 10,000 would have produced an extra 32,000. Just to put in perspective that we had 2 $10,000 investments, 1 year after the other. So hopefully the opportunistic investor who made this decision had already watched one of my segments, or maybe just the batteries were already built in where they had the threshold, that they already realized that a patient, disciplined investor who invests totally on goals has always done really well over the long run, as opposed to the impatient investor who bases things on a reaction, a market perspective, where they try to time things. They tend to end up ultimately being disappointed over time. And that's something I'll share in one of my other segments I'll mention as we wrap up here. So once again, it was really fun sharing this. I hope your time's been worth it. I want you to also have the opportunity, if you want to take a picture of this or just email me just to get a copy of this. It's a quick 5-question survey, not on me, but for you. So you can get an idea of how important these big 5 common concerns are in relation to yourself, whether it's running out of money during retirement, which I know worries a lot of people. Investment volatility could worry people because they could just think of the worst outcome as opposed to the opportunity that comes with the volatility. Increased taxes that I highlighted a little bit earlier. You know, what that means, how does that rate? Next one, leaving a legacy. If that's important, then that tells us a little bit how we should handle certain assets depending on that time horizon. Of course, catastrophic care. We're either going to live, die, or become disabled along the way. It's always one of the three. I'm always assuming we're going to live longer, but I have to be realistic and I don't want to ignore that, and neither should you. With that said, if there's a chance to connect at all or do a follow-up call, somebody out there who we're already working together, or just a friend I never met, that if I can fit in 5 or 10 minutes just to answer some of these questions or just know you a little bit personally, that's fine too. Just check off a few of these time blocks, and if there's something that's available in that particular week in that time zone, I'll reach out to you or have somebody else reach out to you. Again, I'm very encouraged for anyone who's trying to make their situation better, and I think this is a good area to be very cognizant of. So before I wrap up, just also remind me, if you want to attend one of these future master classes, eliminating your 3 most crucial retirement risks. There's 3 multipliers that affect all 18 risks. There's a lot covered there. I highly encourage it. The more wealth we control, though, of course, then the more we have of our friend at Uncle Sam, or the IRS as we call them, that probably would have you on the radar screen. And today, where they need to collect more taxes, for many of you, they may want to also collect for some of the people out there that they can't get taxes from and just get more of it from you. So I'm really telling people, watch out for that. It's another discussion, but I wanted to bring that up because for people that have wealth and they're on that target, we have another process for that. It's called the tax management journey, where we expose the 7 biggest tax traps throughout retirement. That hits home because I come from an accounting CPA background where tax preparation and planning was a big thing. And now we've taken it to a level of tax management. So you can control your money and not the IRS. So as we wrap up, I just want to be thankful again. The exciting part is obviously the disclosure. We always want to remind everyone how important it is to maintain high ethical standards, which includes protecting so many of you from any type of self-motivated sales practices that are out there, or even incompetent advice. I always believe in math and science and the law of optimization, and it's fun to teach anyway. So please feel free to email my office with your self-evaluation. You can see the email address right here. That's just our office picture from our office in Madison, New Jersey. I have one here in Media, Pennsylvania as well. So once again, it was great being here. I look forward to connecting again soon, and I hope everyone stays well. I'll hopefully see you soon. Take care and have a great day and be well.